everyone. It was an introduction. My name's Joass. I'm the Chief Investment Officer of Maven Funds Management. So a little bit about us. We're a Sydney-based investment manager. We've got a few questions if I was going to be starting a New Zealand fund, but we're a Sydney-based fund investing in Australian and New Zealand businesses. And the type of companies we focus on is, I guess you'd call them smaller businesses, but companies that we think have the potential to be tomorrow's champions, so tomorrow's really big, dominant businesses. We're trying to identify them early and hold on for that duration of that high growth period. And so we're launching in early 2020 and putting together a few things now. It's not just me, it's also Travis Mays, our research analyst, which I'm really excited to have join. I wanted to take a moment today to kind of step back and think about why we invest, not just us at Maven Funds Management, but kind of all of us as investors. And if I asked everyone in the room, I think there'd probably be, as many different reasons as there are kind of people here. But I think it really boils down to sacrificing today for a better tomorrow. So that could be providing a better tomorrow for yourself or your family or community, but you're giving up something today when you choose to invest. You're giving that to a company or a fund manager to give that to a business. And what you're really doing, I think, is when you're investing in the share market, is aligning your portfolio and your kind of investing future with this unstoppable engine of human progress that is democratic capitalism. So this is one of my favorite charts. So the green, or the kind of the top of the chart there, is total world population, and the green is people not living in extreme poverty, and the red is the number of people living in extreme poverty. You can see if you extend this back another like 100,000 million years, it would just be all red all the way back. For most of human history, our life has been sort of nasty, brutish, and short for most people. But over the last 200 years, something started to change. I think part of what changed was the shift to free markets combined with democracy and the progress of technology that was fueled by that. So you can see that the number living in extreme poverty has declined significantly as the population has grown. So when we're trying to invest, we're trying to find businesses that contribute to that, and we're trying to attach our portfolios and ourselves to them. And I think that, something that's really important to remember. So that's the why, and then how do we go about doing that? So maybe we have 4 pillars to our investment approach. I'll touch on these quickly and dig into one in a bit of detail. The first is finding what we call monsters. So this is companies that have the ability to increase dramatically in value while creating this value for other people. It kind of took that name from Monster Beverage, which is a company in the US that increased 2,400-fold since 1997. It's a really simple business. That's what I like about it. It wasn't some amazing tech breakthrough. It's just a simple business that could be bought at reasonable valuations, many points along that journey. So we're trying to find those types of businesses early and hold on for that duration of high growth period. I'll touch on that in a sec. The next point is deep research. So that means stepping outside of just looking at the spreadsheets, meeting with management, meeting with competitors, suppliers, customers, and really trying to understand what makes a business tick. Because again, we're buying businesses, not share prices. And another kind of facet of what we do that's slightly different is we try to have a really clear idea of what our thesis is for a company, and then be willing to sell quickly when that thesis is broken. So that's something that I think a lot of investors, as I think Stephen was talking about before, can get stuck into that kind of value trap following a company down. We want to avoid that. Third point is an ownership mindset. So this goes back to what I was saying, why do we invest? We're aligning ourselves with those businesses. That's what we're doing as investors as well. So the majority of our personal liquid wealth is also invested in the fund, both Trav and myself, and anyone else that invests or works for Maven. And that is quite unusual, as Tony was saying. I think 60% of fund managers don't even invest in their own funds, which is kind of crazy to me. But it also, that ownership mindset extends to how our clients should think about the companies they own. We want clients that understand they own a share of a business. And it applies to our businesses as well. We want management teams that are ideally founders that own a lot of the business, or at least act like they own it. The last point is you, and this point we're talking about our clients, but we think our clients are going to be our biggest structural competitive advantage. I think a lot of the problems in the industry come from trying to chase hot money and we're not trying to chase that at all. So we're looking for clients to join us on a kind of multi-decade investment journey to invest along with us. So I'll briefly touch on this. This is from an article I wrote for Catching Monsters. There's a few different steps, and I won't go through them all now, because I've written it if you're interested, but I'll touch on a few of these throughout the presentation. So the first is choosing your hunting ground. It's really a lot of great investing. It's kind of like a negative art. It's really about stripping away the mediocre, and I'll go through that towards the end. Identifying the key traits of what you're looking for. So for us, that's really high returns on invested, incremental invested capital, high retention rates, a lot of the good stuff that makes sense that you'd probably hear a couple other places as well. But we try and dig into it on a kind of different level and identify them a lot earlier. We want to watch closely, so as I said, continuously monitoring and selling quickly if the thesis is broken. And then also being willing to hold on. So there's quite a kind of tension between those last 2 points. A lot of the companies that I've owned previously, a lot of the best winners, actually have amazing times where they decline, 25, 30, 40%. There's multiple times on Monster's journey where it declined that much. And so you need to be able to differentiate between fundamental performance and share price performance and be willing to hold on for that volatility. So the kind of crux of what I want to talk about today is separating what we look for, which is high growth businesses at great prices, from just any kind of growth business. And I think a lot of investors recently have been quite rewarded for ignoring valuation and just buying a business and kind of closing their eyes. And even investors, friends of mine have said, I've learned to ignore valuation. And I think that can become quite a trap. And I think that there's a big difference between a company that's growing and capturing that growth. So let's step back in time. So imagine it's 1960 and you've just taken your first plane trip and you've experienced the future of transport. This is an actual photo from the 60s. It was a little more dignified back then. And you want to invest in this industry. You can see this is going to be an amazing industry. Talking about human progress is going to be amazing for people being able to travel around the world. And if you'd thought that, in one element you'd be completely right. So this is a chart of trillions of passenger kilometres since the 1930s. And you can see that it's just been this exponential growth. It feels kind of slow at any one time, but it's tracking incredibly fast if you zoom out. And I think it's still got a long way to go. You've still got a lot of parts of Africa, Middle East, Asia, people who've never been on a plane before. So you'd be completely right if you'd thought, I see this huge industry, it's going to grow. But if you decided to then invest into airlines, you would have made a terrible mistake. So airlines have been one of the worst investments over the last 50 years. And the reason is that one of those forces driving that human progress is the kind of efficiency of the market. So although there was this huge surge in demand for these products, there was equally great increase in supply. And the one kind of facet with airlines is it's very easy to move that supply around. So it's kind of even different to other industries. If one airline's making a lot of profits on a particular route, all the other airlines kind of hear about it, they send their planes over, suddenly that profit disappears. And this force is actually a good thing for us, right? This is great for consumers. It means that we enjoy low airfares and other stuff, maybe not quite as much dignity as we used to have, but it's pretty good. But it means that businesses themselves are kind of in this survival mode, zero economic profit, and limited capacity for long-term investment. There's another type of business which I'll touch on in a minute, but I do think this is an important part, and I think we want to write it off. But when we're choosing to invest, we want to align ourselves with companies that can actually capture more of their value. And this chart kind of sums it up. So we've got the airline industry, immense value creation for humanity since the 1960s, virtually no economic profit, in fact negative, as I'll touch in a sec. So this chart is from a paper called Measuring the Moat by Michael Malverson. The x-axis shows the share of the total industry investment. So airlines had around 50% of all investment, say airports maybe another 30% of all capital, like billions and billions and billions of dollars that's ever been invested in this industry. And the y-axis is the returns on invested capital deducting for the cost of capital. So if you're above zero, that's really great. It means you're earning an economic profit. It means you're earning returns above your cost of capital. So for investors, that's what we want to see. If you're at zero, that's probably like around break-even, kind of okay. And below zero would be really bad. And so as you can see, airlines, this big blue rectangle, have taken up almost half of all invested capital, but generated a negative return on invested capital, or after deducting for cost of capital for investors. So that means they're effectively destroying shareholder wealth. Then you've got airports, which is pretty negative as well. I think that's starting to change a little as supply changes. But then you've got a few businesses way out to the right here. And this is how we look at the market. We kind of try and strip away everything else and identify what are these few businesses that are actually really attractive. The big one there with the purple bar with around 20% return above cost of capital is actually computer reservation systems, which brings into, I quite like software and enterprise software for that reason. Catering, I think Stephen mentioned catering has a positive economic return as well. So there's a few types of businesses. If you look at those businesses have captured all of the economic profit of the industry, despite hundreds of billions, maybe trillions of dollars being invested in these other businesses. So that's what we're trying to find is these special few and identify them. So why is that? Why did those few make the economic profits and no one else did? It comes back to the simple thing you probably hear 1,000 times, which is a moat. So a moat is a barrier to the world of the free market. It's a barrier to that brutal, nasty, brutish and short free market competition. And it protects those returns on invested capital. It's what stops someone coming and taking it away. And I think there's Porter's 5 forces, other things. The most important is that barrier to entry that stops someone else coming and taking your castle away. I think that this also has a kind of a different benefit. So the free market and efficiency is really great for driving down prices, but these moats can create businesses which can have the ability to invest in new technologies and drive that kind of radical innovation. So an airline is probably never going to make, a radical new consumer invention that we all love because they just can't. They're just trying to survive every day. But other businesses can, and those are the type of businesses we like to invest in. Digging into the weeds a little more on how we go about this, we're looking for companies with high returns on incremental invested capital. That's like the output. So there's something else that drives it to allow them to do that, and that's where we focus most of our attention. High retention rates and production or demand side advantages. So to me, every type of moat can be broken down this way or through a combination of the two. And so what we've got here is businesses kind of earning a very high cash flow margin out here, so like high margin products, like Apple would probably be a good example of that. And businesses up there which are able to produce a lot more for a given level of assets, so they can produce things more cheaply. So if you combine a production advantage and a consumer advantage, you've got something incredibly strong. And this is what we see with the very best businesses. They have something like a Coca-Cola has a brand which increases demand. They're then able to increase scale and supply, drive down costs, and it becomes this virtuous flywheel. Amazon's probably the greatest example in modern history of doing this. And that's how you can kind of combine the two. A couple of other points of how we go about separating the good from the bad and the ugly. Another is just simply unit economics, which is a very simple concept. It just means going through, for a particular company, how it makes money on each unit that it produces. So we look at the revenue, what are its kind of cost of goods sold, breaking down at what point will it inflect past different scale points so that it can scale more efficiently. A great example of this is A2 Milk, a company that I've held for a while. A lot of people looked at that back in 2015 and said it's just another food company, and food companies do have pretty low returns on capital. But what was different, it was a lot more like Coca-Cola, in that they own the brand and then someone else do all the hard work of scaling that. So they've been able to increase revenue from, I think it was 150 million in 2015 to about 1.6 billion today. EBIT from, I think, 3 million to 430 million. That's only possible because they had someone else doing all the hard work. They just captured all of those sweet unit economics. It seems like the fundamental part got cut off somehow in the translation, but fundamental inflection points kind of gets into how I think about timing and entering these companies. So we'll keep a watch list of businesses that we really like, and then when we see what we're tipping past what we call a fundamental inflection point, which can mean be a lot of different things, but essentially it means where the future of the business in terms of its fundamental cash flows is going to be radically different to the past. Again, I'm not looking at share prices, I'm not a technical analyst, I don't believe in that at all, but we are looking at what drives the fundamentals. So in A2's Milk's case, that was launching infant formula and getting traction with infant formula and being kind of the #1 perceived brand, allowed it to explode beyond what it was doing before. This chart's another really important one to me. So we've got the adoption curve. You can see innovators, early adopters, early majority. People are kind of familiar with that. But the next derivative of that is the S-curve of adoption. And I think it's a point that often leads to mispricing. So anytime that we're investing, we're trying to find mispricings because people tend to project out linearly from each of those points on the curve. And for a long time, the best businesses are able to grow much faster than people's projections, which means they're faster than analyst estimates, which means they continue to be upgraded. So we're trying to find companies just in that early adopter phase or maybe moving into the early majority and jump on them then. At a certain point, growth comes unstuck. People start estimating that that high growth will continue forever and it doesn't materialize. And that's why we need to sell quickly when we think a thesis is broken. Just wrapping up quickly, so our process, the starting point for us is to go through each company on the ASX one by one, not screening. ASX is a pretty weird market, so about 30% of it is just mining explorers. This is about 2,200 companies. Another 12% I'd say is perpetually loss-making. There's a whole lot I won't go through, so we need to keep moving on. I kind of sum them up into this. So cash bonfires is most mining exploration companies. Again, I'm not talking about actual mining companies that produce revenues, just exploring for stuff. A lot of stuff in the middle, mediocre middle. We're trying to drill down to our few. So for us, that's the 6% that we call our hunting grounds, all those companies we like to, those traits I mentioned before. Another kind of watching brief group. And these numbers will change a bit over time depending on what the ASX has thrown at us. Recession predicate, kind of preparing for anything that can come. But as I said, we're throwing out most of the market, concentrated into very few, then digging into deep research and owning 15 to 30 of them. And I think if we can do that, we can, again, align our portfolios with that unstoppable engine of human progress. Yeah, so that's all.